full screen. Okay, wonderful. So what I want to talk about today is modern monetary theory, some insights applied to the Ukrainian economy, and some of the concerns that some of you have about, how do we analyze inflation, the risk of inflation from an MMT perspective, compared to the traditional approach that central banks use to deal with inflation. So I'll challenge some of the traditional views, and I'll invite some questions and comments at the end. I'm told that you're a little bit familiar with MMT. You've probably seen quite a bit of coverage in the mainstream media, but especially in the financial press. People like people who are in the financial industry in the last couple of years have been saying that the traditional approach to inflation, the traditional approach to managing the economy has been failing us analytically, and that MMT is offering some useful insights that we need to look into. I'm just skipping through some of the key items that you've probably seen in the financial press in the last couple of years. Mario Draghi, who's not an MMT economist or anything close to that, in the last press conference that he gave at the ECB, completely unprompted, nobody asked him about MMT. He declared that the ECB and European countries should be looking at new insights from MMT to understand what's going on in the economy. And I'll explain why these comments were made by Draghi. So first, let's clarify what MMT is about, some of the key insights. MMT focuses on the concept of monetary sovereignty. And this is different than political sovereignty or territorial sovereignty. Monetary sovereignty is defined in the following way. A country with a high degree of monetary sovereignty is a country that issues its own national currency, which in the case of the Ukraine is the case. A country that collects taxes in the national currency, which in the case of the Ukraine, it's also the case. But number three, this is where countries start to differ. Only issues bonds denominated in the national currency. And as you all know, many countries, including the Ukraine, issue bonds denominated in the national currency, but also issue bonds denominated in euros, in dollars, and other foreign currencies. And that's where countries start to lose a certain degree of monetary sovereignty. And then number four, which is related to number three, is a country that operates under a flexible exchange rate regime as opposed to trying to fix its exchange rate to the dollar or to the euro in order to insulate its economy from the risk of pass-through inflation effects. So as a result, MMT makes a clear distinction between what we call currency issuers, that is the national government that issues its sovereign currency, versus the rest of us users of the currency, that is individuals, households, firms. But if you issue debt denominated in foreign currencies, then you become, as a nation, you become a user of a foreign currency. So you lose a certain degree of monetary sovereignty. So everything we discuss in the MMT space is really related to the capacity of the national government to manage the economy. It's not about individuals or small municipalities at the local level. So don't try this at home. This is for the national government to manage the economy, to manage inflation, and so on. So as a result, we're talking about a spectrum of monetary sovereignty, where not all countries have the same degree of monetary sovereignty. So here on this end of the spectrum, you have countries like the US, like Japan, like Canada. These are countries that don't have any external debt. The entire debt stock of the United States is in US dollars. The entire debt stock of the Japanese government is in Japanese yen, right? So no external debt whatsoever. Now, the ownership of the debt can be held by foreigners somewhere else, but it's irrelevant to the concept of monetary sovereignty. It's relevant in other regards, but it's not relevant in terms of monetary sovereignty. The opposite extreme end of the spectrum here is going to be for countries that don't have any monetary sovereignty. So that it would be countries that completely dollarize their economies, such as Ecuador, for example, completely gave up its national of a foreign currency. Now, most other countries will be somewhere in between here. And what determines where you sit on that spectrum of monetary sovereignty is going to be the level of external debt, debt denominated in foreign currencies. So the more debt you have in foreign currencies, the closer you are to this end of the spectrum. And the less external debt you have, the closer you are to this end of the spectrum. And as a result, countries that have a lot of debt denominated in foreign currencies on this end of the spectrum, they are compelled, they are forced to manage their exchange rate and to some extent fix their exchange rate to the dollar, to the euro, to the British pound, in order to insulate their economy from the inflation pass-through effects, from the external constraints that they face. Because a currency depreciation, if you're on this end of the spectrum, means the next day when you're importing food, when you're importing energy, when you're importing medicine for your people, you're importing inflation with it. And that is typically the case for countries that have the weakest degrees of monetary sovereignty. They typically don't have food security. They don't have energy security. So the Ukraine is, in a sense, is blessed with food security, with energy security, but we can tackle some of these details a little bit. It doesn't mean that if you have food security and energy security, you'll never have inflation and you'll never have external constraints. There'll be other issues, of course. So that's kind of the main analytical lens that we're going to be using. So the question becomes, for countries that have a high degree of monetary sovereignty, say like the US or Japan, does that mean that the US government has unlimited capacity to spend money? Of course not. Of course, you can issue your currency at any moment you want. You can always service a debt denominated in your own currency. But it doesn't mean that MMT is advocating for unlimited government spending, like some people sometimes say in the media. MMT is about printing money. Absolutely not. MMT looks at the real constraints that actually determine how much spending capacity a government has. So the mainstream approach tells us that government spending should be limited by how much you can gather in tax revenues, plus how much you can borrow from financial markets. Beyond that, we're told that you run into the risk of inflation, the risk of high interest rates, the risk of a run on a currency, all of those destabilizing risks. But what MMT is saying, for countries like the US, like Japan, like the UK, there's this additional spending capacity that we're not tapping into. And this additional spending capacity is not infinite. It's constrained, as you can see, by this red bar, which is the risk of inflation. That's the real limit to the spending capacity of the government. So then the question for MMT becomes an obsession with analyzing and identifying the actual risk of inflation, because that will tell us how much spending we're able to tap into without causing inflation, without destabilizing the economy. So for me, the risk of inflation is determined by two key factors. One is a shortage of productive capacity. In other words, if the economy runs out of technology, equipment, skilled people, materials, and we continue to spend, we continue to increase demand, then of course we're going to cause inflation. So that's one limit. The good news about this limit is that it's producible. Productive capacity is producible. You can train more people. You can produce more engineers and technicians and nurses and doctors. You can build more productive capacity in hospitals and factories and so on. So the more you increase your productive capacity, especially in strategic areas where you would prevent those shortages, the bigger that additional spending capacity is going to be. So you can create jobs, you can strategically increase productive capacity in key sectors, and you can push the risk of inflation further out. The second source of inflation, which is extremely important, and I suspect in most countries, including the Ukraine, this is critical, which is what I call the abusive market power or price setting behavior. Here we're talking about market concentration in key sectors of the economy. It could be in finance, it could be in healthcare, it could be in the food price system, it could be in real estate. So the key here is that when you have key players in the economy who can raise prices simply because they can, because they have too much market power, then that risk of inflation is not going to be eliminated by not spending more on health or education or infrastructure. That risk of inflation can only be tamed if you tax and regulate that market power out of existence. In other words, if you democratize that market, if you make it more competitive, less concentrated, that's how you also increase the potential spending capacity of the state by making sure that the market is actually competitive, that you don't have uh, key players in the economy who can raise prices simply because they can. And this is the case in many developing countries. I'm originally from Tunisia, so I'm very familiar with a lot of African economies and Middle Eastern economies. And the key for you in the case of the Ukraine is to identify where market concentration is and identify the actual sources of inflation. Whereas in the mainstream analysis, we're told as soon as you increase government deficits, as soon as you increase government debt, you're automatically going to have inflation. You're automatically going to have, insolvency and so on. And MMT is saying it's much more nuanced than that. And I'll illustrate with a few examples just to show you that in some cases you can have massive amounts of government debt, massive government deficits, and at the same time you have deflation, no inflation. Japan would be a case in point. So this is the paradigm shift in the analytical approach that we're taking to inflation, to the role of government in society, and so on. So the mainstream approach to inflation, if you recall the last 12 years since the financial crisis, most central banks around the world, the ECB, the Fed, the Bank of Japan, have established an inflation target of 2% and have tried every trick in the textbook, literally, to reach that inflation target of 2%. And they have failed miserably because their traditional approach to inflation is misleading, as I will demonstrate here. And this is one of the Fed governors, 2 weeks after he retired. He told the Financial Times, the Fed has no reliable theory of inflation. In other words, we really don't know what causes inflation. So the mainstream has conceded that the traditional theory of inflation, the traditional approach that says more deficits, more government spending, more quantitative easing will automatically cause inflation. We know for a fact that the ECB has failed, that the Fed has failed. The Bank of Japan has been trying this for decades, and they have deflation and negative interest rates despite massive quantitative easing, massive government deficits, and national debt. Here's the ECB inflation forecasts relative to the actual inflation. So the ECB's target of 2%, clearly a massive failure to target inflation because the approach that they're using to determining inflation is misleading. And one of the main arguments that I personally make in the MMT space is that inflation in general is determined by factors that are way outside the jurisdiction of the central bank. Because inflation has to do with these key pressure points that are in the jurisdiction sometimes of the Ministry of Agriculture, of the Ministry of Trade, of the Ministry of Industry. These are, in the government, under the jurisdiction of the government and parliament, in terms of regulating the real estate market, regulating land ownership, regulating pricing behavior, regulating monopolies. That's where inflation sources materialize. In the case of developing countries, it may not be the case for the Ukraine. If your major imports include oil for energy, include food for food consumption, and those prices are determined globally by external suppliers, your source of inflation is determined by OPEC. Your source of inflation is determined by Russia or the United States or Australia in terms of your food supply, whatever you buy your food from. So how can the central bank target inflation when the sources of inflation are determined way outside its jurisdiction? So that's why it's extremely important to have meticulous coordination between central bank policy and other ministries who actually have relatively more influence and power to determine the sources of inflation, to influence the sources of inflation. It's no surprise that the ECB is failing. It's no surprise that the Fed is failing because this is way outside of their jurisdiction. Central banks can regulate the financial system. They can prevent financial crises by regulating and by addressing excessive risk taking in the system. They can target interest rates. They can influence the yield curve, but they can't target inflation. Right? So this is the key message. Here's an example. Japan has the highest debt to GDP ratio in the world. The last number we have right here is 266%. But the entire debt is denominated in Japanese yen. But what have markets been predicting for the last several decades? When we reach this peak, they say Japan is going to default. Japan is going to face hyperinflation. Japan is going to face higher interest rates. And what do we have? Decades of deflation and now decades of negative interest rates, struggling to escape the deflation cycle. Why? Because Japan has a massive productive capacity. It's technologically advanced. It has a huge export market. It's not facing a risk of inflation domestically, right? Japan has other problems, don't get me wrong, but it's not inflation, it's not the government debt, and it's not the risk of bankruptcy, right? Um, Now, countries that have similar levels of debt to GDP ratio can have hyperinflation because they have all the other structural weaknesses that I talked about, or because their debt is denominated in foreign currencies that they can't manage. So here's the Ukraine, very different picture, obviously, but notice the key difference here. Lots and lots of external debt denominated in foreign currencies. That's the source of the pressure point on your exchange rate. That's the source of pressure point on your inflation. That's at least one of the key sources. And that's what determines risk of insolvency for the government, because the government can't be insolvent in its own national currency, but it's certainly insolvent in foreign currencies. And that's what brings speculative attacks from the outside as well. So these are things to pay attention to. So the key lesson is find the source of inflation, whether it's food items, whether it's real estate, whether it's energy, whether it's transportation. It doesn't matter. I didn't mean for these to be in different colors, by the way. So the key here is look for market power and focus on productive capacity. Wherever you have shortage of productive capacity, that's where you're going to see risks of inflation. So I did a little bit of digging, and it looks like in the Ukraine these days, there's lots of discussion about food price inflation, so sunflower oil. And this is really intriguing because the Ukraine is one of the major producers in the world. It's a major exporters, right? So you have domestic food price inflation that is driven by commodities that you actually have plenty of domestically. Now, global prices are going up, as you can see, which means consumers outside the Ukraine will be paying more for it, but there's no reason for the Ukrainian government not to insulate its own economy from this inflation and not to protect domestic consumers from global food price inflation. This is the advantage that you have, which is you have food security, use it domestically to protect the economy, right? Now, you start digging a little bit further and you realize that this is really about market power, right? And I see this in Tunisia with importers of wheat. We import a lot of wheat from the Ukraine, by the way. Importers of gasoline, importers of medicine from outside. They have exclusive power, in many cases, exclusive licenses to import these key items. What do they do to use their market power? When global prices go up, they raise their prices naturally because they import it. But then when global prices go down, they don't reduce their prices by at the same rate. They take advantage of that and they abuse their market power and they make the local consumers pay for it essentially. And as a result, they accumulate more economic power, more political influence, and more dominance in the market. So this is what we're talking about, democratizing markets to insulate your economy from these external shocks. So you realize when you start digging into the Ukrainian economy, there's all kinds of interesting political discussions happening the last few years related to land ownership. And this is critical, related to borrowing in foreign currencies, borrowing from abroad. And the red flag started going up when I started seeing this, which means if the Ukraine is not very careful about the land reform, you're going to have a huge speculative cycle in the next few years. You're going to have much more market power concentration in the agricultural industry for big agricultural companies, which means you're going to have much more control over the price system by key players. Now, this raises the risk of inflation. This raises the risk of corruption. This raises all kinds of red flags. And why do firms want market concentration? It's not just for market share, but also because now without land ownership, you can't borrow internationally. right? Because a bank will not give you a loan unless you actually own the land. So these are, I sense this, and please tell me if I'm wrong. I sense that there is an attempt to blackmail the country into these very rapid reforms in order to increase market concentration and market power. And this in the long term will increase external debt, which means increase the vulnerability of the economy to external shocks, will increase market concentration, and will possibly lead to a speculative real estate cycle that will eventually crash like any real estate speculative cycle across the country. And it's not just in agriculture, obviously it's in cities and so on. So it will become more exclusive. Land ownership becomes more exclusive, home ownership becomes more exclusive. So it feeds into inequality as well. So these are red flags that I see, which means, pay attention to these things. As a person who's interested in the risk of inflation, I'm telling you, this is how you look for risks of inflation. If you're interested in real estate, I'm telling you, this is how you look for real estate speculative cycles. If you're interested in debt levels for consumers, for businesses, and so on, I'm telling you, this is where the cycle might start to accelerate. So what MMT says from a national government perspective is decouple or separate the spending from taxing. Both are important functions. So spend on national priorities, on your food security, energy security, technology, infrastructure, health, whatever it is, society decides these are important priorities. But then tax pollution, tax speculation, tax extreme wealth, not because the government needs those revenues, but because you want to decarbonize, because you want to reduce speculation, because you want to reduce inequality. Those are very important functions. But the national monetary sovereignty doesn't need tax revenues in order to determine what to spend on. These are both important functions, but separate. Tax to protect democracy from oligarchical market power concentration. Tax to reduce this excessive wealth and abusive market power. These are the goals of taxation. And the higher the degree of monetary sovereignty, the more resilience you can build, the more you can apply of these principles. But if you're borrowing in foreign currencies, you can't do this, right? Because you have to earn that foreign currency in order to pay for it, which means you need to export more, you need to attract foreign direct investment, you need to bring in tourists, something, right? Which means you dedicate more and more of your resources, real resources, to paying for the external debt. So that's the risk that many countries face. I'll give you a few examples in the case of the US, just to illustrate how national governments that have full monetary sovereignty or high degrees of monetary sovereignty. The US paid for World War II, which was the most expensive program. It came right after the Great Depression, the most miserable time in US history. There was no money to be taxed. There was no money to be borrowed. In the US during the Great Depression. And then we go straight into this massive spending program. Where did the money come from? Congress votes and approves the spending. Money is created into existence. That's how national governments always spend. As soon as you have consensus on a national priority, the spending takes place in the national currency. But then the immediate concern is about the risk of inflation. What will people do with this new income, with these new jobs that we've created? They could possibly go on a shopping spree, buy new cars, buy new homes, buy whatever they want, which means, do we have the physical productive capacity to build new homes, to produce new cars, to produce new items for consumers? That was the real problem during World War II. There was no physical productive capacity left to produce consumer goods. So we had to convince consumers to abstain from consumption during the war. And it was done in a variety of ways, one of which was selling government bonds. They called them freedom bonds at the time. Selling government bonds was not to finance the war, because the war was already financed, but it was to take purchasing power away from consumers and ask them to postpone their consumption until after the war. And it's guaranteed AAA rated government bonds, which means after the war, everybody got paid plus their interest. And that was the post-war boom. The other element that allowed the US to tame the risk of inflation was actually controlling and rationing the actual physical commodities that were necessary for the war effort, like rubber and metals and other things. The US didn't produce any new vehicles during the war. The entire city of Detroit was retrofitted to produce military equipment. There were no new car models produced between 42 and 45 because all the resources were dedicated to the war effort. So that's how you realize that it's really about the real productive capacity. And it's really about managing the risk of inflation. It's not about finding the money somewhere. Same thing with the CARES Act. When the pandemic started, nobody in the US Congress asked, where's the money going to come from? Who are we going to tax? Who are we going to borrow from? It was a 100% consensus that we need to spend this money to deal with the pandemic. And there was, as you can see, there was no risk of inflation. So when we're told we don't have the money, we're broke, we're going to borrow a lot of money, we're going to cause inflation and hyperinflation like Zimbabwe, this is, call their bluff. Now you know what the sources of inflation are. Now you know the difference between a country like Zimbabwe and Venezuela, countries with very weak degrees of monetary sovereignty, with massive amount of external debt. They're very, very different than Japan, than the US. And now you can figure out where the Ukraine sits on that spectrum of monetary sovereignty. It's clearly not on any of the extremes. It's somewhere in the middle. So to acquire a higher degree of monetary sovereignty, now you know what the possibilities are, what the real constraints are, and what the real risks for inflation are. So I'm hoping that with this, we have a little bit of a roadmap to move higher on that spectrum. So number one, distinguish between debt denominated in currencies, foreign currencies versus the national currency. Use fiscal policy space to build more resilience to external shocks, to increase productive capacity in strategic areas. And then tax and regulate not for revenues, but to reduce inflation, speculation, inequality, abusive market power, and so on. And look for the actual sources of inflation in the real economy, whether it's in the food sector, whether it's in real estate sector, whether it's in transportation sector, and look for market concentration, because that's where the red flags will emerge. Red flags for inflation, red flags for abusive market power, red flags for speculative cycles, and red flags for corruption as well, because this is what power does. And with that, I'm happy to stop here and answer any questions. Thank you again.
Thank you, Fidel.
Thank you. And I'm happy to share the slides with anybody who wants to have them.
Thank you, Professor Kabuk. We have some short question for Professor Kabuk. I have first question. What is your opinion if the United States now had a fantastic situation, interest rate of the Fed's fund of 7.5%? How many years or decades would the US have come out of the COVID crisis now?
So you're saying if the US
extremely high rate of central banks, if we have as in Ukraine now, 7.5%.
So is the question, what if the US had an interest rate of 7%?
Yeah.
So you're asking me a hypothetical, like today, if the US had an interest rate of 7%, like the Ukraine, how would it get out of this crisis?
What is your opinion about perspective of economy of USA?
Very, very good question. So I think I understand why you're asking this question. So there's a huge differential between the interest rate in the Ukraine and the interest rate in the rest of Europe and the United States, the UK, and so on, which creates this, built-in incentive and I guess demand or movement to be able to borrow at lower rates, which makes borrowing in foreign currencies attractive. On those terms, yes, it's attractive, but what I tried to demonstrate today, that it's very dangerous for financial stability. It reduces your monetary sovereignty, it increases the risk of inflation as well. So it is attractive in the short term, but in the long term, it's destabilizing. So there's this argument that raising interest rates, an MMT argument, that raising interest rates actually causes inflation. Whereas the traditional view often says raising interest rates lowers inflation. Well, it depends what the source of inflation is. So let's say, I'm making this up, hypothetically, one of the sources of inflation in the Ukraine, and again, I'm making this up, is imports of some item from Germany, right? So how is raising interest rates going to lower the prices of those items that are determined by German and Japanese and American firms? It has nothing to do with it, right? So, but when you raise the interest rate, thinking that it will, tame inflation, you end up raising the cost of doing business for domestic businesses. You end up increasing the cost of borrowing for local consumers. You end up, and for businesses domestically who have a dominant market position, if their cost of doing business goes up, they're going to pass it on to consumers, right? So you're actually feeding inflation. This is point number one. Point number two, for debt holders in the Ukraine today, who are financial institutions, pension funds, wealthy individuals, when you raise interest rates, you're transferring more interest income to them, right? So it feeds into inequality, and it feeds into, if they happen to have, quite a bit of, influence in the domestic demand, so you're feeding inflation too. So that's why it's very important to analyze the sources of inflation. And if the source of inflation happens to be market concentration in the Ukrainian economy in a particular market, then raising the interest rate or lowering the interest rate will not do anything to that market power. It's outside of your jurisdiction as the central bank. It's in the hands of the parliament that regulates monopolies, that regulates markets, that has the capacity to introduce more competition in the market by supporting startups, supporting small businesses. So you democratize the market, right? So I hope that I'm answering your question and the way it was intended.
Thank you, професор Кабук.
Thank you.
Колеги, в кого ще є питання, можна задавати українською. Пан Олександр Вальчишин перекладе для професора Кабука. Прошу піднімати руку.
Там є питання в чаті.
Чи є питання в чаті?
Fadel, we have a question in the chat from Tatiana Ziber.
Yeah. Professor Kabuk, we have in the chat one question for you, please.
Sorry, but mic is muted.
I'm sorry, I was saying I see the question, but I'm not sure I completely understand it.
It's too naive question. Sorry, it's my question. It's about, do you have any thoughts of which direction nowadays, after the COVID or during the COVID, during this climate changes or other problems, are for the countries the lowest risk of inflation when the country will start to expenditure, will start to spend? Or to which direction country should spend with the lowest risk of inflation?
Okay, so in general, I'm not obviously an expert on the Ukrainian economy other than the little bit of general knowledge that I have. But in general, my advice to countries is to build resilience in the key areas of the economy. That starts with food security, energy security, infrastructure, healthcare, education, but especially education that creates the skills that allow you as a country to develop high value added industries. So you have countries that simply import components and capital and intermediate goods and produce assembly line types of jobs. Those are low value added contents. Those are the countries that end up in the weaker end of the spectrum of monetary sovereignty. So you want to produce the infrastructure and the skills and the research and development capabilities that allow you to move up the food chain, so to speak, to produce the highest value added content, meaning more technologically advanced products. That allows you the highest degree of resilience and highest degree of monetary sovereignty. No surprise that Japan is up there. No surprise that the US is up there, that the more technologically advanced countries have the highest degree of monetary sovereignty. So my advice would be, that's the way to tame the risk of inflation across the economy, by building resilience in those areas. But the biggest risk, say, for the United States is market concentration in the health insurance industry and the healthcare industry and the energy and transportation industry. Those are the risks of inflation that we have in the US. Market concentration in real estate, which is huge in the United States. We call it the FIRE sector, finance, insurance, and real estate. That's where sources of inflation are. And that kind of inflation is not going to go away by not building infrastructure, by not funding education and health. That market power goes away if you tax it and regulate it and make it more competitive. So the challenges of inflation from an MMT perspective are very different than the traditional view that says more government deficits will automatically cause inflation. I'll give you a simple example. Let's say the Ukraine decides we want to spend, I don't know, $5 billion in the next 2 years on producing solar and wind power in the country, hypothetically. And those, $5 billion will employ 300,000 people plus the technology and so on. I'm making up these numbers. And then you realize, what will those workers do if we pay them decent wages to do the work? What do they do with this new income? They're going to buy food, they're going to buy housing, transportation, entertainment. It's a free country. They buy whatever they want. And then you realize, wait a minute, we have plenty of food supplies for them to buy more food, to buy more transportation, but we don't have housing for those individuals who now have the purchasing power to buy a new apartment, to buy a new house. So you realize that this new spending is going to create an inflation pressure point in the housing market. So what I would do, instead of spending all the money on building solar power, I would spend 80% of that money on building solar power and then dedicate 20% of the spending to building more productive capacity in the housing market. So this way you're increasing the purchasing power and creating jobs, but at the same time, you're adding to the productive capacity. That's number one. Number two, you have to look into the real estate market. Do you have market concentration? Because building more productive capacity and giving it to the same market concentration source will not solve the problem. That will still make housing exclusive for the wealthier. So you have to regulate. That may include rent control, that may include land regulations, property regulations, taxing property ownership beyond your first home, and so on, in order to make housing more accessible for the new people, the young people that you're employing. So that's why you have to look beyond just direct spending and inflation correlations. I hope this answers the question.
Thank you. It's even more than I expected. It was very useful. Thank you.
Thank you.
Thank you. We have another two questions in the chat. Please, Alexander Volchichin, translate this question in Ukrainian to English for Professor Kabuk. One question about Biden administration and MMT, and the second question is about Taylor's rule and inflation. Please, Alexander.
Fadel, I have already translated the question.
Oh, in the chat. Okay.
On the Biden's.
Oh, the question about Biden is: do you consider the Biden 1.9 trillion spending an evidence of MMT? So MMT doesn't need any sort of program to be implemented. MMT is saying this is how the government operates all the time. So to some extent, I guess yes, because it shows that Congress can vote and approve the spending, $1.9 trillion and $2 trillion last year for the CARES Act, without declaring where the money is going to come from, who are we taxing, or who are we borrowing from. Notice that now Biden, in this new wave of spending for the $3 trillion infrastructure plan, he's changing his narrative and he's saying, oh, we need to tax the wealthy and we're going to pay for it. But if you actually run through the numbers, there is no way that the tax amount that the Biden proposal is going to bring in is actually going to pay for the infrastructure program. So he's using this as a political narrative to calm down the individuals who are worried about the deficit, worried about the debt. And I think that's misleading. That's like shooting yourself in the foot, so to speak, politically, because you're giving your opponents evidence that says, this is how I'm going to pay for it. And by the way, I don't have enough money to pay for it, right? So you're giving them ammunition instead of explaining clearly how the federal government pays for these things.
For the next question, I translated.
In the chat, okay. Question about the Taylor rule. Yeah, so as I said earlier, something like the Taylor rule from an MMT perspective is not the right framework to think about the risks of inflation. And I think the question is referring to worsening the already weak bank lending to productive private sector. Yeah, as I said earlier, if you're raising interest rates thinking you're going to fight inflation, you're weakening your domestic producers, and you may actually be feeding inflation because you're feeding it through the interest income channel for bondholders who receive more income, for savers, but you're also creating this situation, which is, I think, the most important one, where you're increasing the opportunity or the incentive for your businesses to borrow internationally, which means to accumulate more external debt, which creates financial instability on their own balance sheet because they're facing the exchange rate risk constantly to make payments, but also ultimately, this is a burden on the country as a whole, because a lot of this debt in foreign currencies is in many cases probably guaranteed by the Ukrainian government, especially if it's for large enterprises and large state-owned enterprises too.
Thank you. We have two questions, one from Tatiana Bogdan and from Artem Gargun. Pani Tatiana, ladies first, please.
Thanks a lot, Professor Kabu, for a valuable presentation. And in view of the main provisions of your report, I have the following question. How do you assess the inflation targeting monetary regime that central banks in the world have accepted? And do you recommend such monetary regime for emerging market countries and Ukraine in particular? And if not, how do you think what is a good option for Ukraine? And if we don't accept inflation targeting, should the central bank target, for example, interest rates or monetary base or other monetary aggregate? What is your opinion and your view on that issues? Thank you very much.
Very good question. So as I said earlier, most central banks that have inflation targets, the ECB, the Bank of Japan, the US, the UK, have failed miserably at targeting, at actually meeting that target. And if you remember historically, before central banks started targeting interest rates, central banks used to declare the money supply target, and every single central bank on the planet has failed to meet or to hit the central bank target, the money supply target. So what I tried to explain today is that if you want to target inflation, the main institutions that will be successfully able to target inflation are typically not the central bank, or at least it's the central bank in conjunction with other institutions, especially if the actual sources of inflation, the inflation pressure points, are determined externally or internationally. For example, I'll give you the case of Tunisia. One of the major sources of inflation in Tunisia are energy prices and food prices. We import a lot of wheat from the Ukraine and Russia and so on. How can the Tunisian central bank meet its inflation target if the price of wheat is determined by the Ukraine and Australia and Russia and the US? Completely outside your jurisdiction. How can the central bank target the inflation if one of the main sources of inflation are energy prices determined by OPEC? There's no way that the Tunisian central bank can actually target inflation. And yet they try. They raise interest rates and they continue to feed into inflation. So that's why it's very important to think through the actual sources of inflation pressure points and determine, in the case of Tunisia that I mentioned earlier, the only way to insulate the country from the risk of wheat prices going up, therefore the risk of food price inflation, is to actually build resilience domestically so that you produce more of your wheat domestically. Instead of prioritizing producing strawberries, which is not necessary for food security, but it happens to be a major export item. So we dedicate the most precious fertile land and the most precious water resources to produce a commodity for export, and then we depend on wheat imports from the Ukraine, from Russia, from Australia, with no control over the price system, right? That's what I would do. So it's the Ministry of Agriculture that's responsible for that source of inflation. It's the Ministry of Trade, it's the Ministry of Energy. That's why it's very important for the central bank to be independent politically. So I'm not against central bank independence in that sense of the term, but to be strategically cooperative with other entities in the government so that you actually help the central bank meet its inflation target. And of course, we don't see any of that. In most of the cases, central bankers are saying, we know what we're doing, we're following the model, and you, the government, the parliament, do your own thing, which I try to demonstrate here. You can't actually do that successfully if you really are concerned about inflation targeting.
Thanks a lot.
Thank you.
Thank you, Professor Kabub. We have a question from Singapore. Artem Gergun, acting member of Ukrainian Society of Financial Analysts, now in work at Asia. Please, Artem, your question about policy regime recommended by MMT for mainstream or not mainstream. Yeah, please.
Yeah, thank you very much for giving the floor to me. Thank you very much, Fadel, for your truly illuminating presentation, and especially for the ECB inflation expectation slide. It was truly spectacular. Thank you very much. I have a question. What is the main MMT recommendation regarding the monetary policy regime? Does it have the same significance as in mainstream theory, for example, building foreign reserves mantra? Thank you very much.
Very good question. So for countries on that weaker end of monetary sovereignty spectrum, in order to insulate their economy from the risk of inflation, like I was explaining the case of Tunisia, because our inflation sources are wheat prices and oil prices and imported medicine and medical equipment from abroad. So what happens is, if your structural trade deficit creates a downward pressure on your exchange rate, it means that the next morning when the country is going to import food or medicine or gasoline to run the economy, all of those items will be more expensive, so you'll be importing inflation. And we've seen this in Tunisia and other parts of the global south. Within days, you have food riots on the streets because people can't afford food, right? So what does the central bank do in order to protect itself from that political and social instability that's driven by that external constraint? The central bank steps in to fix the exchange rate artificially high. And the only way to do that is by borrowing dollars or euros or British pounds. So that became the standard approach, which means central banks have to build a substantial amount of reserves. The IMF recommends 90 days worth of imports to protect the economy for those key imports. And that external debt keeps accumulating because it's debt in foreign currencies that you have to pay either by exporting more, by bringing more tourists, by bringing more FDI, which means in order to attract all of those FDI and export-led growth, you have to race to the bottom because you're competing with another 150 countries who are just as desperate, right? So what do? You subsidize your hotels, you subsidize the food system. And of course, when you bring millions of tourists, you have to feed them. So you end up importing more food, more wheat from the Ukraine. You end up importing more gasoline from Saudi Arabia, right? So you're feeding the inflation pressure points with the presumed solutions, because now you're obsessed with earning dollars and euros to pay for that external debt, to defend your exchange rate. And that's a trap, right? So what I say always, if you're in a deep hole, the first thing you do is you stop digging. You don't dig faster. And in fact, most countries try to dig faster because they want to accumulate more external reserves to protect the exchange rate, to protect that risk of inflation. And that's a temporary band-aid solution. But in the long term, your infection is getting worse and worse and worse. And that's typically the case for most countries in the global south. The Ukraine obviously is not in as desperate of a situation as many developing countries, but it's still part of that trap, which means the monetary policy framework, the standard framework, is still obsessed with currency reserve accumulation, with export-led growth, with attracting FDI, which means your parliament is probably doing what many other parliaments around the world are trying to do, which is lower taxes to attract foreign investors, lower regulations to attract foreign investors, deregulate the financial system, which attracts speculators, obviously, eventually. So all of those are risky solutions, but desperate situations lead to those risky solutions. What I'm saying is be aware of those red flags, because in the long run, they're extremely destabilizing, and focus on long-term resilience. And those are the things that will actually give you the monetary sovereignty, higher degrees of monetary sovereignty that I explained. Monetary sovereignty is not something that you declare, it's something that you earn through hard work. And you have to do through strategic investments and strategic visions.
Thank you.
Thank you very much, Professor Kabuk.
Thank you, I appreciate it. And I'm sorry I took too much time from the other speakers for this conversation.
Thank you for your brilliant presentation and answer about our questions. Thank you. And we have very pleasure, glad to see you in our next monetary theory seminars in Ukraine.
Thank you.
Healthy and be happy. Thank you.
Thank you. I'm happy to contribute anytime, and I'll share the slides with everybody. If you have any questions, you'll have my email. Feel free to reach out.
Mm-hmm.
Enjoy the rest of the meeting. I have to go to class.
Thank you.
Thank you so much.
Thank you. Bye-bye.
Have a good day.
Thanks.